Hello and welcome, traders. My name is Peter Caraverdi, and I'm the founder and the head mentor of ForteTrader.com. And I'm going to be teaching you guys this bootcamp course for the next several hours. Sit back, grab a notepad, and let's have fun with this. In the beginning, could be a little bit redundant. Some of the first chapters here, or lessons, shall I say, to some experienced folks out there. Definitely folks that have experience in outright future trading, but please, bear in mind too, there may be some things you can learn out of it. Just be patient. I appreciate it as we get more into the spread trading boot camp. But again, welcome everybody. I'm happy to have you here. I finally found a place in my life with trading. I want to talk quickly about myself, just so there is a face and a name behind the voice of this boot camp. Okay, some of you may have already met me online on maybe a YouTube channel or on another webinar, or maybe you've met me in person somewhere in public and have ended up here as a desire to learn more about what I've spoken about and introduce to you briefly elsewhere. So again, thank you very much. I appreciate that. My name is Peter Caraverdian. Again, I'm the founder and mentor. I put a picture here of my wife, Romana. This was us several years ago, back in a trip we had taken over to Florida, over in the Everglades. We like to travel, whatever it is we can do and fix within our budget and time. That's what we love to do the most. It is fun. It takes kind of stress away from other daily living and things like that. I've been was introduced to my trading since 2010. And from 2010 to about 2013 was hell for me. It was just like back to school, back to the hard knocks, and just was very tough. That was my experience zone. Okay, I went through a lot of schools, a lot of mentors, a lot of learning curves, a lot of loneliness, a lot of feeling like I just, no matter what I did, I was alone. The support I had from my family and my wife just still sometimes just didn't feel like enough, because the trading wasn't within them. It was only within me in the virtual and the digital world. Anyone I approached or I met personally was a higher up institution level person. Never really had much time to work with me or talk to me about trade talk. So it was very, it felt super lonely. Sometime to this day, it kind of still does. But I've been able to cope with it and just learn and manage with it. Also, one of the other reasons I built the school was to be surrounded by trading people from all levels. Okay, just having the desire as an individual that of finance, I just love being around those individuals. Okay, so including all yourselves. In 2013, I had launched the school with my head mentor that had taught me technical trading at the time, and I launched everything. I had some technology skills, and I was able to build build a lot of the back end of the website myself, and in hopes that I kept learning more and was a student of the trades back then. I still felt that that would have been beneficial to run, and we parted ways since then. I kept everything open because it was just, very low overhead to keep things open. That's the reality, things the internet, and with my skill set on technology stuff, I kept it open, and knowing that one day there was going to come a time where my trading came together confidently year over year, and big or small, where I could just have my full calling and put this thing on full time myself. So thus, I kept it open up until now, and it was definitely well worth it. Personally, since then, I've been producing consistent returns, 40 to 70% per year, and that's strictly with spread trading. Okay, I love to trade. I don't really love, but I like to trade equity options. I've tried different strategies on them. Spread trades on equity options where they're a little bit different. I'll discuss that in the future. A little bit boring for me. I was challenged to try to hit home runs, so I was constantly losing money until this day. Sometimes it's just more to me like a different kind of odd attempt of a little bit of a skill, technical entry. I'll try to use some of my fundamental skills I've learned over the years with the commodities and futures, but then again, it's just kind of it's not as consistent as what I've been performing with spread trading. That's why I introduce that to people. That's why I teach that to people, because I know that although legally I cannot promise such results, in a world like this, we're highly regulated, I can definitely, with confidence, illustrate through my experience and teach and mentor and assure almost that people will have a more consistent return as long as you put in the work, okay, and learn it. It's almost just like more of a statistical edge at this point, the way that we approach these trades. And so yeah, and because the overall fact, my experience, I've been always kind of like a subcontractor of anything since I left my parents' house. 11 years I worked in the legal industry. I literally was just like a fancy motorcycle messenger, but I met so many wealthy and smart people, and it changed my mindset. Never really went to college, was a first-year college dropout, but was always an entrepreneur spirit. I love to help others. I was able to illustrate a lot of that in the legal industry I was in. One thing led to another from a lot of the big guys I met there that pushed me into sales because of who I was as an individual. I managed to get myself in the car industry. It was a love-hate relationship. I overall hated it. There was years I made 6 figures, years I didn't. And that was a time to get out at that point. That was a signal for me to get out. The finance dreams were coming together for me. It was still very painful, but I always kept an entrepreneur way of things since I've left my parents' house, and just hustled until I get to where I wanted to be. So again, my passion is to help others. So I knew that once this program of spread trading came together for me, I was instantly going to start relaunching the course because I already had the technology behind it and the experience behind it. To pretty much get this course up and running for everybody and get everybody up to par. And that way I get to help others. It feels like now at this point, this is my calling. Okay, so I really love to create that freedom away from corporate world. I like to keep it. Sometime, there's up and downs that have come around through there and painful moments, tons of them. But I feel that the amount of time it took me to learn everything and the amount of time the amount of time it took me to learn everything, I can cut that down drastically for people. I took a lot of long ways to learn stuff, and spent a lot more money than I should have, but it all kind of illustrated to me at the end that, it brought me to where I was. I was consistent. It cost me more, but I think, again, with the higher cost and time it cost me, I could cut that time frame drastically and cost to people, making it much more fulfilling much quicker. Okay, real quick here before I get into anything else, guys, every little video here there's going to be this little disclaimers. I got to do it by law. We are in a world of super high legal disclosures, especially when we're dealing with trading, folks. One thing I love about the futures and commodity markets, it is ran by the exchanges like the Chicago Mercantile Exchange. We have a few other exchanges within, that run our commodities within the U.S. And I really, really do like that. It's there to protect you. Okay, it's there to protect the consumer and everybody else that's involved. And so, but with that said, though, I have to put on, illustrations of disclaimers, talk about it, or you could read about it. But I'll have to do this quite often. You'll see this. You've probably seen this a ton of places everywhere. Please bear with that. So, if you've already read it, great. Just remember, anything that we illustrate, we cannot promise that it can happen or the same results will happen in the future. Long story short, and also be careful with, the capital you use on trading. Everybody has different results. Some people could be lucky. Some people just right off the top get it really quick and are natural talent at it. Maybe using some sort of part of their brain better than others. I don't know. It just takes some people quicker, some longer. Bottom line is, if you're using money, your risk capital, make sure that it's money that you can afford to lose. Don't be high-end risk taker. A lot of us do at the end of the day. I know I did more than once, but again, we gotta just disclose it. Just be careful with that, okay? Don't risk your family's livelihood and things like that for this. Practice. We have so much technology now these days that can help you. Okay, like practice for free, literally. All right, the technology is to our advantage with trading these days. It totally is. Okay, so let's go ahead and get into the introduction. Okay, introduction to future spreads. What type of spreads are we working with? And let's go ahead and talk about a couple of little definitions here again. Spread trading in a futures world means the purchase of one or more commodity and sale of one or more of the related commodity. Okay. Now, do not mistake this kind of spread trading with the difference in price between two or more price values. What I mean by that, and I'll illustrate that later, is the difference between bid and ask. Okay, bid and ask. For those of you that are familiar with already trading, or you've been you've traded stocks, you know the difference between what people are willing to bid for it, pay for it, and the difference between the ask is what people are willing to sell for. Sometimes there's a price difference in between there, and that is considered a spread. Okay, so we don't want to mistake it with that, and neither do we want to mistake it with options spreads. Like I was talking about earlier, I like to play on the side and don't talk much about it. The equity options, which just is a fancy word for stock options. Okay, well, a lot of the guys that like to play the safer side out there, they like to sell, options, and it's basically like credit spreads and things like that. If you've heard of them, fine. If not, don't try to dig in and sidetrack from boot camp and figure out what it is. Don't even bother. Stay away from it. We want to focus our attention on future spreads, okay? And futures trading is the process of trading commodities. We can do them mostly, and most people and professionals especially do them in annual cycles. In annual cycles. In other words, seasonal spread trading, okay? Annual cycles can get influenced by certain conditions such as weather, cold versus warm weather, political circumstances, or seasonality, and affect the demand and supply of the selected commodity for trading. So as an example, gold price in the winter, okay? Gold price in the winter can get expensive because a lot of people use gold for gifts during the winter, right? To buy, their loved ones presents made of gold. So on a seasonality level, gold could increase naturally during this time frame because of that the season of the holidays. Okay, so seasonality, it equals predictability. Okay, and it helps us out, and that's where we start in our future spread trades, because most of it is a seasonality trade, and it gives us a little bit of more consistency, because the tools that we're going to offer and show you is going to provide you with statistical data. Now, when we have statistical data, we can use that to our advantage and have an edge in a specific trade versus just a straight technical trade on a certain level, or just a gut feeling or something like that, or because you particularly just love a stock and so you want to just buy it for the long term. We're actually just trading these things. We're doing it to make money. We want to make good money doing them. And so we'll try to use a seasonality to our advantage. Okay. Now, what is a futures contract? Again, this is a boot camp. I'm expecting that there's going to probably be some beginners here, so I just want to mention this real quick on one page. We don't want to get too much about in the basics of what a futures contract is per se, because there's a ton of free things like that on the internet. Okay, you should have probably already known or should know what a futures contract outright is by the time you're here. So I don't want to bore everyone with it. If you don't know, real quick, we'll go through these and then I'll just give you some references on where you can learn a little bit more from it, from the exchanges, which is the best place in my opinion. It's not another third party giving an opinion. It's an actual factual database from the exchange that can give you some free little one-on-one videos on economics and futures and such. So I'll show you that in a second here, but when you trade futures, you do not buy or own anything, but rather you are speculating on the rise or the decline of the price of the commodity you are trading. Okay, in other words, you are betting on the future price direction. Therefore, analyzing annual price patterns of a traded commodity is the vital aspect for deciding which future contract you're going to buy or sell. As an example, let's assume you're interested in trading cotton commodity by speculating when it is the right time to buy or sell the future contract on the cotton. The right time to buy the future contract is when you assume the future price will go up on the cotton, as opposed to selling, where you would sell a future contract after assuming the future price would go down. Okay? Every trade always has a buyer and it always has a seller. There is no ownership obligation of a commodity. The only obligation you, as a buyer or seller, have is to deposit capital with the brokerage firm to cover the losses in case the chosen trade that you chose goes in the direction of a loss. The root of a future trade lays in the direction of the price of the commodity contract. If the price moves in the right desired direction, the trade will profit. If the trade takes unwanted turn, the trade will lose. Let me go here real quick to a website and show you guys. Okay, this is the CME Group. Okay, if you put on your browser right here, make notes of that. CMEGroup.com. This is the website for the Chicago Mercantile Exchange. This is the exchange that governs most of the futures and agricultural and energy indexes of futures. If you come over here to trading, there's a bunch of product information you can get through here. Here's the main featured products. But for now, because we're in lesson 1 from CMEGroup.com, you just come here to education, and you can pretty much learn future fundamentals and get all kinds of relative data. It's a really nice website. Play around with it. You guys probably most of you already have. If you've come this far to learn future spread trading, most of you are probably past this stage. But again, for everybody else, this is where you want to study and learn all this free data. You can log in here, and there's some basic videos. CME Group will definitely educate you on anything you'd like to know about any of these commodities and futures. Okay, so let's get back to our PowerPoint. All right, so what this boot camp will teach. Participants in this strategy are more concerned with the relationship between the legs of the spread than the actual price or directions of the actual market. This thus is called relative trading. Legs, for those of you that are new, is each commodity per contract. So like if you were long crude oil 1 month, let's say March, and you are short April, that's another leg. So March is one leg, and then you are short on the other one. That's you're relatively trading that commodity, and that's a relative trade between each other, but each one is a leg. Okay, just want to make that clear. Some of you probably going, what leg? What the heck is leg? That's what that is. Okay. What we're trying to attempt to do, one of the things that we're doing is we're reducing volatility. Okay, volatility is the rapid movement of the commodity, which, when you're in a trade and it's something volatile, some professionals like it, but for the most part, it can hurt you. It goes against you. It's very volatile, especially in a commodity market where you're placing a lot of stop orders. For those of you that are here from the outright futures trading, outright, what I mean is just straight up trading futures, straight direction, 1 contract, 10 contract, 100 contract, straight directional trading. You're not spread trading. And a lot of you have probably felt getting stopped out a lot. My first 3 years, stop. Everything was stopped before I was right. I got stopped before my direction was usually right. Hated it. Okay? What we're doing is we're reducing that volatility, and then we're hedging away from the base currency risk. Okay, systemic risk. In this case, most of us would be the dollar. If we're trading a lot of the U.S. commodities and stuff, we're talking about the dollar here. Okay? Systemically, and even from gap up and downs of the outright. Okay, so what we're trying to gain here is consistent profitability. This is what we're trying to get out of that. And then cycles in the market due to weather and harvest and or holidays, are pretty much offering us the opportunity of predictability. Okay, so this is what we're going to try to gain out of this spread trading boot camp. All right, and just so you guys know, spreads have 5 different ways they can profit. Unlike a trade you take outright, you're either right or wrong, and that's it. Okay, and so we'll discuss later on as will make more sense. Okay, as you grasp one spread order, how this can benefit us rather than trading the single outright or day trading strategies. This thus is a hedged strategy. It's like insurance. Okay, and I've just finally put this in here as a little idea. Think about it. An insurance company structure, how they operate their business, okay? Why not operate your trading like an insurance company? Spread trading and using systemic risk away from the dollar, hedging by using two legs, and spread trading, which is what we're going to learn here, which is basically all comes down to relative trading. It's operating in a more insurable way, utilizing all the tools that everyone else has in the markets, and be just as profitable too, or maybe less profitable, but a little bit safer, longer lasting. Okay. And a side note, guys, personally, what I've learned over the years I've been involved is a lot of the big traders out there and the professional traders that have survived really long and haven't had heart attacks and lost homes or spouses have usually been able to do it. And I'm not trying to be biased here, guys. A lot of respect to every other different trading style, but most of those longer lasting traders out there that have been able to pull it off, that actually have a lifestyle, that are comfortable, that aren't full of anxiety and ADD, they're spread traders. This is just what I've seen, what I've met, what I've encountered. I didn't want to accept it my first 2 years because I wanted that quick home runs and stuff like that. I wanted to be able to get away from an efficient market, fight the efficient market, and figure out how I could, hit grand slams all the time and get out of the situation I was in life. So, we're going to learn that, and let's go into seasonality. All right, seasonality. Most commodities, unlike stocks, they have a huge annual cycle due to the market participants that are involved. We're going to learn about them in the next lesson. Predictability and sustainability is likely in markets where seasons and products play an annual role, and this is why we base our level 1 and focus primarily on seasonality first. Okay? Gold and heating oil, they become really expensive right before Christmas season. Why? Well, we already explained the gold, right? Holiday gifts and such, and heating oil, because the winter gets cold, right? So right before Christmas, all that holiday season, heating oil tends to kind of get bought up actually post-summer once we start looking into our seasonal charts, because most people are buying it up. Suppliers and producers are buying it up right before the season. So then as the season of cold comes in, you'll start seeing a decline because all of that was bought up. But it's a seasonal pattern, seasonal tendencies, okay? There are strategies that you can implement, and these are the names of them. Let's go through them really quickly. We've probably gone through a lot of these on webinars, and this kind of stuff has been available on YouTube, okay? It has been available on YouTube, but we want to go through it. We need to go through these in these boot camp. These are important terms. There's a lot of words in trading that are mind-boggling, and I almost want to say unnecessary. We have to learn some of them and understand them because everyone's using them out there. At least if you're going to touch the stuff, we want to know what they are. So we're going to stay away from some of the ones that are ridiculous and we don't need them because they're just designed to just confuse you and probably cost you money if you don't know what it is. It's not worth it. Intra-market spread. Okay, just like interstate truck drivers and intrastate truck drivers. That's how I recall it. Intra-market spread is simultaneously going long on a future or a commodity of one kind in 1 month and then short of that same kind in another month. That's an intra-market. Okay? When we do that, that's going to be like our first base trades that we take when we start because they're the least volatile, they're more consistent, they cost very affordable, a reduced margin to get in them. You'll see what I mean by that. That's really exciting. Okay, another word that shouldn't be so scary or mysterious from now on, intermarket spread. That's basically simultaneously long of futures of one kind or short on that front end, and then short or long opposite on the back month, okay, of a related futures market. What does that mean? It could be like meats, like different meats, like hog versus cattle. Okay, or live cattle versus feeder cattle or whatever. But it's related. It's kind of like or a wheat versus corn and things like that. They're related. They're grains, they're meats. They're not the same, but they're related. Okay? And they're in the same exchange as well. Okay? Let's go to the next slide. Inter-exchange spread. That's basically long futures or a commodity at one exchange, short future commodity of a related future at another exchange. And in this one, the good example of this is a very popular one can be, we have two different kind of wheats here in the United States. One is from Kansas City and one is from Chicago. They're on two different exchanges. Kansas City has an exchange. Chicago is the main one, the biggest one. I mean, CME. They have the Chicago wheat. Okay, so there's two kind of wheats. One is known to have more protein than the other. Guess what? I didn't know any of that until I got into commodities. Which, side note, another good reason to get into these stuff, it gives you a good pulse of the markets. It gives you an idea what's going on in the world. I didn't pay too much attention to a lot of general things, including some politics, because, geopolitics is a big fundamental aspect to our trading. It started giving me a little bit of a pulse of what's going on around me. So, inter-exchange spread, it could be like Chicago wheat, you're going long on that, and you're shorting Kansas City. You're technically using two different exchanges, and I'll talk to you a little bit more about that in the future, about how margins work on that. A little bit different, but it'll all come together. The fourth kind of trading, people that do spread trades that has nothing to do with us, but just so you know that it exists out there and it'll make sense, institutional hedge spreads. These are more like considered like synthetics. These are where big institutions are maybe going long or short on the actual commodity also, but they may be doing something synthetic, like actually, going the opposite direction on an option or something like that. Okay, so but they're institutional. They hedge their spreads. They're called synthetics. They're basically, a lot of, let's say, to give a easier example to some of you that have a lot of stock experience, they talk about how options were created as originally a derivative for people that like big institutes that, let's say, buy or sell stocks, a lot of quantity of stock. They want to hedge their trade. They want to protect themselves in case it goes the other way. They want to protect their investors, right? All the 401ks and stuff out there. So what they'll do is they'll buy or sell an option on the other side of it to protect their investment, okay, in case they were wrong. Because even they don't know. Most pros, at those levels don't know as well, right? It's, quote unquote, fingers in the air. And so there you go. These are the different kind of names of the spreads. And the next page here is this is a 15-year seasonality of, now you're probably wondering, RBOB, what is that? It's the technical word for gas, just pretty much the gas future contract. And as you see here, every different color, we're going to learn this, and this is going to become natural to everybody here, which I'm excited about. Every single color here is a different, in our spread trading platform, is a different average up to the 15-year mark of seasonality, okay? So each one is a different year. One is like a 5-year average. Another color could be like a 10-year average up to a 15-year. And that black line that you see where the arrows are following, that's the current year spread of gasoline. So basically in this case here, we see how a lot of the, during the season, a lot of the seasonality of the spread can be pretty relative at certain times of the year. Like here where we see in October, where that arrow is going down there, towards the end of the year and beginning of 2019, we see a nice decline. Gasoline made its highest price, and it starts getting into a lower pricing as the winter kicks in and summer driving becomes peaks out and starts declining. Okay, people driving less, and as you see, it's a really good seasonal opportunity there. Okay, where you can short gasoline as you see into February. Summer months start coming back up. Boom, gasoline starts going up. Premium starts getting higher up towards the summer season, where driving becomes a lot more popular. Okay. Here's a really good spread speculation that we have. It could be a seasonal tendency on heating oil versus gasoline coming out of the summer season, where we find heating oil being purchased more as the winter months start getting nears us. We know that up in the Northeast area, especially, heating oil is very popular. There's a lot of homes up there built with the old systems. And heating oil becomes a very, very big thing there. as of now, as of the time I recorded this, natural gas eventually is starting to be drilled into those areas. And I know because I've visited those areas. But it's a typical, very popular, spread that could take place here, where we anticipate that, winter driving will, as the summer ends, will reduce, and so people will be buying less gas. So a good outlook would say, okay, well, let's go long heating oil versus shorting the gasoline market. Now, this would be a perfect a commodity spread trade, and what we're trying to do is between these two, as they widen out the price, you profit from it if you're going long oil and short gas. Okay, you're hedging your trade, you're in an actual intra-market spread, and you're out of some of his systemic risk that the dollar can cause onto you. Now, some of the things that can change pricing here that are usually gets in the way of, seasonal tendencies of working out, of course, is weather changes, which is the largest thing, war, geopolitical events, and lately, especially as of the time I'm recording this, tweeting. Certain people tweeting in headlines. Headlines can really, especially on oil and gas, headline can really move and rock energy markets. Okay, not as much on some of the other ones like grains and the meats, but definitely on energy sector. So a headline rapidly can move something. So when we're trading outright oil and stuff, that's why it's very hard to do. A lot of people I know, very hard to do, unless you have a ton of oversupply of money. Even then, without the experience and money management skill, spread trade is the way to go. Okay, so let's take this as a little example here and have fun with it. Okay, so when we want our spread, like our front month, to go up, we're going long, we expect it to widen. All right, we'll go through this so many times that you'll get familiar with this, folks. Be patient with it. It'll come together, make a lot of notes. If we were going the other way, where we wanted oil, front month of oil to go, we're shorting it, and we wanted gas to go up. So maybe coming out of the winter months, going into the summer months, we would be basically be wanting it to narrow. Okay, so but in this case, it's a widener. We want this thing to widen. We want the ratio to widen, the price difference, relative difference between the two. And so let's say, here we go, we want oil to go up while we want gas to go down. Some kind of fundamental news kicks in. Let's say the weather, the winter is kicking in too slowly. Okay, now what happens is the price starts going down. There's still like less demand here. The demand is already going down. Most of oil has already probably been bought up, the heating oil, but we're seeing less demand as the winter looks like it's staying warmer. And at the same time, it's bringing people out to drive a little bit more, and because there's a little bit of shortages in our Cushing, Oklahoma, in our storage facilities, and we haven't been pumping as much on some oil reports. The prices of oil have been coming up, so now what's happening is our price is narrowing in, so we're kind of losing a little bit on our initial profits, but we're still not losing, right? We still have exposure in the market, we still have skin in the game, we're just, our profit is coming down a little bit. Following week, for whatever reasons, again, there's a big oversupply into the winter months, and so a good report comes out, well, a hefty report in your favor, there's a lot of oil supply, and so prices on oil on the gas goes down. At the same time, it's still a little bit warm, it's not cooling as quick. Your heating oil is still making a little bit of a downward move. You're long, but see, now gas has also gone down, so it's balancing out your trade. Okay, it's balancing out your trade. You're able to still do things. You're able to go work. You're able to live your life, hang out with your family. You're not out of this trade yet. And that's the cool thing about this. Following week, there's a blizzard that comes in the Northeast. Boom, heating oil skyrockets. People freak out. That's just the nature of the markets. Emotions kick in. And now it's really widening out. Okay, your trade is working out. But because oil prices are so cheap, and Saudi Arabia typically, of course, they want to make $100 a barrel again. They announce that they're going to stop producing oil, and they send, people into a panic, and price of gas goes up. They say we're not gonna sell, our 750,000 barrels that we export a day. We're gonna stop doing that for a bit because we need the price to go up. We're not okay with $36 a barrel. So next thing you know, that's happening. you're still in the game. You're still at a profit. And then our president turns around and tweets something and says, nope, you better not do that. So they turn around, because this is what they do all the time. I noticed. They freak out. And they drop that price back right on back down and start exporting oil. Now you got this super big whitener right here. And months later, maybe 4 to 6 weeks, which was the average spread trade, you're in this thing at a nice profit. Okay? You've made money. And guess what? You just accomplished an awesome, successful seasonal spread trade. Pat on the back. Big digital high five. And that is what I'm talking about. This is how we do spread trades. This is a very successful seasonal statistical trade. We're going to get more into this in the next chapters to come.